Certainly not to the same extent as then. I think corporate balance sheets in Australia are in very good shape, and it's really only the odd instance that you could point to really around a corporate needing perhaps additional equity. But certainly as a broad generalisation, balance sheets are in much better shape. Funding markets are still open for the vast majority of corporates in Australia, offshore funding markets that is, and there are certainly no liquidity or credit concerns of note at the moment. But that doesn't mean that, as you fast forward a couple of years and interest rates are a little bit higher, that those concerns can't eventuate or indeed be raised. But right now there's nothing obviously sinister to do with the balance sheets or funding for corporate Australia. I think it certainly features very heavily because investors increasingly are much more strident in their demands of boards and making sure that the CEOs and the boards of companies invest at above cost of capital rates of return. And I think there's a lot more scrutiny now around what these companies are investing in. And I think BHP is a great case in point because you rewind a few years ago and they were on the acquisition trail and buying international companies, shale oil for example, which didn't turn out very well. Whereas now, you could say the company and the board indeed have, capital management religion, or certainly a very evident discipline around where they think they're going to make money and where they should be spending that incremental dollar of investors' capital. So now the capital management strategies of a lot of corporate Australia are very well telegraphed to investors. So you can really get a good sense of what to expect, where these companies are going to invest the money, and the sorts of returns that you might expect as a result.